5 seconds to the open. Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
All right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you along for the ride today. As you heard, my name is Jerry Robinson. I'm an economist. I am a trend trader. Been coaching traders here at Follow the Money since 2010. And I'm also an author of the book Bankruptcy of Our Nation, a book that goes in and out of vogue based upon who's in office and based upon what the current political sentiment is. Our book, by the way, Bankruptcy of Our Nation, is available on our website or in fine bookstores, also on Amazon.com. And it talks about how we have created a system that is untenable, that is unsustainable. And what we have certainly seen over the last decade has been an enormous amount of money that's been printed by the central banks, not just the Fed, not the Federal Reserve here in the United States, but also the ECB, the Bank of Japan, the Bank of China. Many of these different central banks have all got together and realized that if they pump money into their economies, they can stave off the natural reactions that come in this capitalistic system. And so by pumping more money or pumping more air into the balloon, they're creating this bigger and bigger bubble. And it's really quite concerning when we look out and see how high many of these stock market prices have gotten, what real estate prices, how high they've gone, and we don't know where it ends. We don't know how long the funny money can keep propping up these asset prices, but we know that the monetary authorities are going to do all that they can to keep the this dog and pony show going. But as we talk to our students here at Follow the Money a lot, we explain that we are heading right towards a brick wall or off the cliff, however you want to describe the illustration. But we are heading towards a day of reckoning here in the United States, and there is no way to avoid it, short of going through it. And one of the quickest ways that we could go through it is for the Federal Reserve to raise interest rates to natural levels, let them find their natural rate. And of course, you would have economic devastation, but that would be preferred to them trying to put more and more and more air into the balloon, and then it pops. Well, that's even a worse kind of situation. And that's where we're heading, apparently. And now, as I record this podcast on Wednesday morning, the 26th of February, we now see this week that volatility has struck in 2020. That is volatility, the wild price swings that we have seen in years past, now reviving their head again here in 2020. Now, we have been on a big rally. If you look at the stock market, since October, we broke out on the S&P 500 above that 3,000 area. That was the key area, 3025, somewhere on the chart. If you look at the S&P 500 chart, we broke out above that level on rising volume, and then we just kept running to 3,100, 3,200, 3,300, 3,400, and that's where we ran into trouble in early February. 3,400 was the near-term top. Some would say that it may be the all-time high, but and it is the all-time high currently, but can we push past it? Now, that's going to be a big question here. But overall, the pullback has been healthy. I mean, this is something that you would typically want to see in an uptrend. You don't want to see, just an uptrend going straight up. That usually ends very poorly. So we do want to see a 45-degree angle of the price, and that's what we have been seeing since October, but we've pulled back. We pulled back below the 50-day moving average. In fact, as we're doing this broadcast, the S&P 500 sitting at about 3150. So it's still above that 3,000, 3025 area, that range of support, which we'll be watching very closely on the S&P 500 chart. If you look at the Dow Jones, I'm looking at a chart of it as well, it actually lost its 200-day moving average, although the moving average was bullish. It lost that moving average earlier in the week. I think it was on Tuesday. Today, it's trying to retake that 200-day moving average. If you look at the NASDAQ also topped out about 9,700 in early February or earlier in the month. And now we have sliced through the 50-day moving average support, and we're sitting at about 8,900 as of this broadcast. Now, we haven't just seen volatility strike stock prices. We've also seen volatility strike cryptocurrency prices. Cryptocurrencies have also been reeling in this moment, likely for other reasons, perhaps. Maybe there's been some profit taking. But what's driving much of this pullback? What are we seeing here? Well, there's two major things that I just recently told our students about on our Tuesday coaching call. So for all of our gold and platinum members here at Follow the Money, we do a live conference call on Tuesday mornings at 10 o'clock Central Time when the markets are open, so that we can talk about what's happening. We can provide trading coaching and investing coaching, and then we can also answer questions and talk about any relevant news. Well, there were two things that I spoke about to our coaching students yesterday on the call, and these two things, of course, the one is most obvious, is the coronavirus. So the coronavirus, which seems to have an origin in China, has been spooking the markets. Now, we've seen this before in years past. We've seen similar viruses that seem to be potentially out of control in pandemics, things like the Ebola virus or the Zika virus or the bird flus, the swine flus we've seen over the years. And oftentimes you'll see a really sharp reaction by the stock market. They often say that the stock market, takes the stairs up in price and then it takes the elevators down in price. And if you look at a daily chart of the S&P 500 this week, well, you sure can see that. You can see how the stock market was climbing up at a nice 45-degree angle for months. And then suddenly, all of a sudden, it just goes straight down like a waterfall or an elevator. And that's exactly what traders and investors need to know about the market, is that that's exactly how it works. They take some time to go up, and then when they come down, boy, they can come down in a hurry. One of the fears, however, is that this coronavirus is a pandemic that is going to spread not only through Europe, which it already has now. We've already seen cases in Italy, and it's spreading in other areas outside of China, but we're also seeing, some cases here in the United States. And this certainly is creating a cause for concern, not only for the devastating human toll. I mean, I'm looking at some data here, and I don't even know if it's accurate. I'm looking at, CDC information. I'm looking at other data that's coming in, and who knows what the actual numbers are, if they're even getting the numbers right. But the current coronavirus cases right now, as of this morning, Tuesday, the 26th, according to the best data that we have, shows that there's about 81 to 82,000 confirmed cases of coronavirus. And that's important. Those are confirmed cases. Those are cases that we know of. These are cases of people who have actually gone in and been diagnosed. Of those 82,000 individuals, then we have about 2,700, 2,800 of them that have actually died as a result of this. And if you look at the compositions of death on this, it is primarily, not always, but primarily the elderly, people who already have compromised immune systems, people who are already dealing with some health issues or maybe some pre-existing conditions. And when this coronavirus comes along, which is something that the human body is not quite prepared to handle, it's a novel virus, the one that we're dealing with now. In essence, what's happening is we're seeing the death toll affect the elderly community much more. But of those 82,000 cases that are confirmed, about more than 30,000 of them have already recovered. And so I think the big fear here, there's a twofold fear. A, people with compromised immune systems, this could really be devastating to many people in many countries who have compromised immune systems or have other pre-existing health conditions if this spreads. And it seems to be very easily spread, it sounds like. Best thing to do is keep your hands washed and not be touching your face all the time if you're in a big crowd, especially if you're in an area where it's known to have been an outbreak. The second concern, aside from the obvious human toll and the suffering that goes on here, is what's going to happen to the businesses that have been shut during this time. In China, for example, many businesses, many of them have closed their doors. for fear of this. In some cases, the government has required that or forced that. And so, what is that going to mean in terms of lost productivity, right? This is where we kind of get to the math of the situation. And of course, it's more cold and calculating than the real human toll. That's obviously much more important. But investors and traders, and a lot of the large investors around the world, they're concerned about what this is going to mean on the quarterly reports of some of these companies, right? Not only China, but some other areas in South Korea and other areas as well. Apple has already warned that some of their, production in China, the activity there has obviously slowed. So the stock market really has to reprice in all of this new information. And where that price is going to be, where the right price is, we don't know. That's why we're seeing this volatility now as investors try to reassess and say, okay, what's the real economic toll going to be here? And because there's fear, uncertainty, and doubt, we call FUD, right? Fear, uncertainty, and doubt that's surrounding the coronavirus, there's just no way to know. And so it's very likely, very, very likely, that we are either going to underestimate or overestimate the impact of the coronavirus. It's unlikely that we're going to nail it on the head. So this means that we should probably expect more volatility ahead as the market kind of tries to figure out what the economic toll of this really is going to be. Okay. And I think the other fear is that if we begin to see the coronavirus spread to the United States, that you could see some of the same slowdown in activity where people might stay home. They may not go out to eat. They may not go to the movies. They may not go out shopping. They may not go to big events. And of course, that will have an impact upon the economy. And of course, that has to be priced into the stock market because the stock market is composed of companies who report earnings and revenue. And if those revenues and earnings are impacted, then you're going to see a new price assigned to many of these stock prices. And that's going to have an impact, of course, on the major market indices like the S&P 500, the Dow Jones, the NASDAQ. And these are the areas, of course, that I really teach our students. If you don't have a niche market, if you don't already have a market that you really like to trade, then focus upon the indices. Focus upon sectors within the indices. And that can really, serve you well as you're trying to discover your own niche. But I really enjoy trading the indices. I like trading the NASDAQ 100. I like trading the S&P 500. I like not having that single stock exposure that is so common whenever you're just dealing with individual stocks. I prefer ETFs and indexes, indices. Okay, so the first reason why we're seeing volatility strike is the coronavirus, the threat of it, the fear, uncertainty, and doubt that surrounds this virus. Okay, the second reason, and this is a big reason too, it's not quite as explicit in the media, but it's very obvious if you have eyes to see what's going on, is that if you have been paying attention at all here in the United States to the presidential debates, and if you've been paying attention to the Democratic presidential campaign, you will find that there is one man who is emerging victorious out of every single caucus vote so far, and that is Mr. Bernie Sanders. Bernie Sanders has won the popular vote, according to the data I have, in every single state that has already caucused, and that is quite telling. Additionally, he is also running number one position in most polls, not only against other Democrats who are running for president this year, but also against President Trump. And the Democrats are desperate for to have a nominee who can actually stand their ground against President Trump. And it's still too early to know, perhaps, but it does seem that Democrats are beginning to rally, and I'm talking, when I say Democrats, I mean the people are rallying around Bernie Sanders. Because if you look at the Democratic National Convention or the committee, I mean, they are, Bernie Sanders might as well be a piece of kryptonite, right? They don't want anything to do with him. They already tried to trip him up. They destroyed his chances in 2016 through some real nasty shenanigans that they pulled. And it looks like they're already trying to do it now. And I was even recently mentioning that I haven't seen a presidential candidate despised by both sides of the aisle since Ron Paul. Remember back in 2012, Ron Paul was running for office, for the presidential office, and he was on the Republican ticket. He was getting a lot of votes, winning the popular vote in some cases, winning caucuses here and there. And the right-wing media just absolutely despise Ron Paul mostly because of his position on the military, where he wanted to bring troops home. But there were other things too, like the amount of spending and all of this. All these things were a negative for Ron Paul from the Republican side. Of course, the Democrats didn't like Ron Paul's candidacy because he was a Republican, but the Republicans didn't either. So Ron Paul was like this weird, strange, unusual presidential candidate who didn't have any friends. He didn't have friends on the Fox News circuit, and he didn't have any friends on the MSNBC circuit. He was just all by his lonesome, and of course, he didn't make it very far as a result. We had Ron Paul on this broadcast several years ago and asked him about that, about why do you have such, why don't people support you on the Republican ticket? And he tried to answer. But anyway, I haven't seen this level of disdain for a presidential candidate on both sides of the aisle since Ron Paul. So Bernie Sanders, of course, is despised by Fox News, right? Obviously, Fox News talks about Bernie Sanders like he's the second coming of the devil, or he's the devil incarnate, or whatever, because of his claim of socialism. Now, we've talked about socialism on this broadcast before. In fact, I did a really interesting podcast several months ago called American Socialism 101, where we talked about what socialism is. And unfortunately, the noise around capitalism versus socialism has become so distorted that you can't even have a rational discussion upon the topic, which tells us there's tremendous amount of propaganda around this topic. So not only does Fox News and the right, despise Bernie Sanders, as I guess they're supposed to, but the left also despises Bernie Sanders, right? The leaders of the Democratic National Committee, they're almost committed to making sure that Bernie Sanders is not the nominee. They don't want him to represent them because of whatever reason. And it may be for the fact that he has zero billionaires promoting him, right? Or standing behind him. What billionaire is going to stand behind Bernie Sanders when he wants to tax billionaires, right? Now, I can understand why billionaires would be opposed to Bernie Sanders. That's why you have more than 60 billionaires supporting presidential candidate Joe Biden, or more than 50 billionaires supporting Pete Buttigieg, Mayor Pete. You have a lot of billionaires supporting other candidates, but Bernie Sanders has zero. So if Bernie makes it to the actual national stage as the nominee, which will be literally near a miracle if the Democratic National Committee actually allows that to happen and doesn't try to play funny games with the numbers. If that actually happens, what you're going to have is you're going to have basically a presidential debate of one man who is advocating for the rich, and those who support the rich and those who defend the rich will be supporting him. And then you're going to have one man advocating for the poor, and those who advocate for the poor and defend the poor over the rich will be supporting him. And so we really have this poor versus rich showdown that could potentially be coming. Now, the media and the Democratic National Committee and all of the rich out there are not interested in hearing the debate. They don't want to hear the case for the poor, right? They're not interested in hearing that. They don't want a man in the Oval Office who is advocating for the poor. That's not what rich guys pay presidents to do, right? That's not what they give them money to do. The way the system works in the United States is that if you are rich, then you have great amounts of support from who? Well, you have support from whoever's in office who you've given money to, right? And if the guy in office won't take your money, or if the guy in office is more concerned about helping the poor than he is giving you as a billionaire another tax break, then you don't like that guy, right? And you certainly don't want to hear about the plight of the poor, because that means you might have to open up your wallet. And then, of course, it gets into this downward spiral commentary on the virtues of capitalism and the virtues of socialism. And then you just end up in a wild discussion, which really often goes nowhere. I'm working on getting our good friend, Professor Richard Wolff, who we've had on the broadcast several times, back on the podcast to help explain what socialism is. So I'm not a political hack, right? I don't get into these debates over right being better than left or left being better than right. I'm not a Republican. I'm not a Democrat. It's almost like watching a car wreck. I mean, kind of like a rubberneck. I mean, I do like to pay attention to the debate, I guess, from an outsider standpoint, just to see the sheer nonsense of so much of it. But I don't have a dog in the fight. And so I'm able to size this up. I'm able to look at it from an objective standpoint. And I see something coming. If Bernie Sanders wins the nomination, you could really see a lot of volatility. And this is going back to what we were talking about, is where is this volatility coming from? It's coming from the coronavirus and the uncertainty, the FUD, the fear, uncertainty, and doubt around it. But then you have the Bernie Sanders FUD, right? The fear, the uncertainty, and the doubt expressed by the rich, saying, what is this guy going to do? Is he really going to win? And the more that it looks like Bernie Sanders might win the nomination, I would submit to you the more that the stock market is going to experience volatility. And I'll even go further and say the more that Bernie Sanders' chances against Trump, if he does win the nomination, go up, the amount of volatility in the stock market will also go up. So the Bernie Sanders phenomenon could wreak havoc, I guess is what I should say, upon the stock market in 2020 because there's a lot of fear, uncertainty, and doubt around that topic. So not only have we seen, as I mentioned, stocks react to this, we've seen the VIX, the volatility index, pop on this news. It popped right back to where it was actually in late 2018. And we might actually be surpassing it here. We're going to keep our eyes on the volatility index and see. Now, it's also very likely that we're going to see a relief rally here, right? Typically, you don't get this kind of sell-off for several days without getting a relief rally. And that relief rally, by the way, may be a fake out, right? It may just be a dead cat bounce, but you still get one. You often tend to get a relief rally, and that'll be really important to pay attention to, because if we are entering into a new downtrend, then what that rally will look like will probably be low volume, followed by another high volume sell-off. And if that occurs, then that may be indicating to us that we are entering into a new, at least a sideways grind throughout the rest of the year, or maybe parts of the year as we head into this 2020 election with uncertainty, fear, and doubt surrounding it. Or it may mean that we are moving into a place of great profit taking, and individuals are simply just locking in their gains, and they're going to wait for this 2020 election and the coronavirus to kind of fade before they step back in strongly. So, no one has a crystal ball, and no one knows what's going to happen tomorrow, let alone what's going to happen 6 months from now. But we do know what is actually causing this fear. We know that it's the coronavirus and the fear, uncertainty, and doubt that surrounds it. And also Bernie Sanders, to a lesser extent, but still very important, the rich who are invested in the stock market, and they see Bernie Sanders rising in the polls. They see him rising in the caucuses. They see him winning these things. They see him winning these debates. That's a cause for concern if you're a billionaire, right? I personally am not a billionaire. Are you a billionaire? Are you worried that Bernie Sanders is going to come after your money? There's a lot here, and we're going to unpack this more because we'll have plenty to say as we get closer to the 2020 election, and it certainly could have an impact upon the market. By the way, gold and silver also looking interesting. I want to talk about them on the other side of this break. We'll come back with just a few more comments. We'll be right back. Hold tight. You're listening to Follow the Money Radio. We'll be right back. Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2727. 2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812. All right, friends, welcome back to the program, followthemoney.com. On the web, you're listening to Follow the Money Radio. My name is Jerry Robinson. So the 30-year Treasury yield is at a brand new all-time low. And for those who don't know what the yield, the Treasury yield, what that means or what that signifies, that's the amount, that's the interest rate that the government pays whenever you loan them money for 30 years, right? So you say, I'm going to give money to the United States government for 30 years, and they're going to give me less than 2%. Well, that's the case now. We've now hit a new all-time low. So why would the 30-year Treasury yield fall whenever we experience volatility? Well, the answer is quite simple for those who remember finance class, Finance 101, how bonds work. When people buy bonds, it drives down the overall yield, right? So more demand for bonds as bond prices go up, driven up by demand, then the yield that bond pays or yields is going to go down. Likewise, if people begin to sell bonds and really take on more risk, maybe they move out of bonds and move into stocks, well, then you certainly are going to see the yield rise in a way to, basically to attract investors back into bonds, right? So the yield speaks to us. It tells us something. It tells a story. So when the yield, the 30-year Treasury yield, hits a brand new all-time low, that's telling you that people are doing what? They're piling into long 30-year bonds, expecting that rates are going to go even lower. And this is probably going to be followed up, with a Fed rate cut. If you look at the expectations of the rate cut probability by the Federal Reserve at their upcoming meeting, it's been ranging anywhere between 18 and 25% of expectations for a rate cut in March. That number goes up significantly to, I think 30 or 40% by April. And then it goes up really high by the time you get to the middle of the year, by June or July. So investors are expecting a rate cut over the next few months. And you can certainly see that by the yields plummeting upon many bonds. And of course, telling us that individuals are piling into bonds in seeking perceived safety, right? We've also seen a big rally, as I mentioned before the break, in gold and silver. If you haven't looked at a chart of gold and silver lately, it's really quite stunning. And by the way, you can go to followthemoney.com/metals, metals like precious metals, just the word metals, and you'll find there we have charts of gold and silver, palladium, platinum, gold mining, all of that stuff there for you. But, gold, since we entered into 2020, right at the very end, in fact, around Christmas time, we began to see gold break out of a bearish channel that it had been in since August. We had these big gains in gold, you may recall last year. But then, when you get a big gain in an asset, then you enter a period known as a consolidation period, where those gains have to be digested, right? And so you kind of digest those gains, and you may go sideways for a while, and then you'll break out again if the uptrend is strong. And that's exactly what happened with gold. So at the end of last year, the end of 2019, gold reemerged out of its consolidation pattern that it had been in since about August. And it began to break out, and it moved higher. And it moved past the 1550 area, which had been resistance. And now it's moved all the way up to 1650. But the volume level on gold is also very telling, right? So we've been bullish on gold for a long time, but we got real bullish last year. We issued new uptrend alerts on gold last February. And then we also issued a brand new uptrend alert on gold in early June, the first week of June. And since that time, of course, we've seen gold really do well, and it continues to move higher. I'm of the expectation, I believe, that we're going to see brand new all-time high set in gold, very likely over the course of the next 12 months. That's my broken crystal ball prediction, right? Because nobody has a crystal ball, and Of course, no one can tell you where things are going to go, but based upon the strength of this uptrend, I don't think it's out of character here for gold to just keep moving in this environment of uncertainty. Of course, we'll have pullbacks. Nothing goes up in a straight line. But I think we'll probably see a new all-time high set on gold, or at least the high we saw set back in 2011, sometime over the next 12 months. I think it's very, very likely with all of the uncertainty, fear, and doubt, the FUD that we talked about a little earlier. The dollar has also been very strong in this environment. It's finding resistance at the 100 level on the U.S. dollar index. It's at about a 3-year high right now. For those of you who are not students or members here at Follow the Money, last week we issued an alert to our Platinum members telling them that the market had reached an area where it was due for a pullback, and we began taking gains in some of our 3X ETFs that were long the market. That was on last Thursday. And then on Friday, we completely closed out our positions that were long 3X ETFs, and we moved into short position on Friday. And then we held that over the weekend. And of course, Monday, the market opened up and it was down. And that did really well. We made 10, 15% in one day just off of that trade, just holding it over the weekend. And the market, again, the market is going to move up and down. And one of the ways that we like to determine where things might be a bit frothy is a real simple indicator that we offer on our market tracker page, which you can find. You go to followthemoney.com/market-tracker, tracker with 2 Ks. You can also just go to our website and click on the investing resources up there in the menu, and you'll find the market tracker. And there we have a simple time-tested indicator that you can look at that shows you whenever enough stocks get to a certain level, there's a take profit signal that emerges on this chart. And we've been using this chart for many years successfully, so you can find that on our website on the market tracker area. So it didn't really take our members, our students who were tuned in and dialed in, it didn't really catch them by surprise. By the way, our sector rotation portfolio that we track also for our members has been doing very well so far this year. We have utilities, real estate, and technology as our top 3 sector rankings for the beginning of 2020 for Q1. Utilities and real estate have held up very well despite this onslaught of selling. Technology, of course, taking it in the nose. It led the market throughout much of the beginning of this year, and now it's leading along with energy, which has also been in the doghouse for a long time. They both led to the downside here. But utilities, real estate, and technology remain our top 3 sector picks. We're going to announce some new ones at the beginning of April. Every quarter, we announce our favorite sectors to all of our members for the next quarter, and we rank them every week based upon relative strength and a few other technical indicators for our members. So again, if you like to trade, one of my favorite things to do is to trade indexes or trade sector ETFs, right? That way you have a nice big basket of sectors that you can kind of choose from, and then you don't have to worry about that single stock risk. By the way, we have an upcoming trend trading boot camp. If you want to learn a simple step-by-step system for trading the financial markets, you want to learn from me directly, I'll teach you. I've been doing this for many, many years. I've taught thousands of people around the world. It's pretty crazy when I think about it, but we really have. We've taught so many different people the art of trend trading, and you can make money in this environment. And I think there's going to be quite a bit of money to be made on the other side of whatever this is we're going through. So if you want to learn how to do that, if some of this just doesn't seem to register with you. If you look at a chart sometimes and you say, I don't understand what I'm looking at, I get that. But we can help. We can help show you exactly how to read a chart. And chart reading can be one of the most fantastic skills that you ever learn. And so let us teach that to you at our Trend Trading Bootcamp. You can learn more about that. It's coming up April 18th, and you can find out all the details by going to followthemoney.com/bootcamp. Okay, so we talked about several things. I want to talk just briefly also about gold and silver. So gold, as I mentioned, about 1650 is where it's at now. That's a really key area of support. We would also be watching the 1550 area also as support for this rally. Physical silver has had a hard time breaking above 1850 for years. It'll retake it for a few days and then it'll fail. This has been going on since 2013, right? In fact, you can go back even further and see where 1850 has been a real heady area. It oftentimes is the area that's broken to the upside before a big, massive rally begins. So 1850 on the silver chart is a key area to watch. Can we hold that area? What's going to happen around that area? We're watching. Also, you can watch a rising 50-day moving average on silver, which is currently around $18, and also a rising 200-day moving average, which currently sits at about $17 on silver. We'll see if silver can hold its gains here in the midst of all of this. And then finally, I wanted to bring up cryptocurrencies. Really interesting that cryptocurrencies are moving the way they are right now. If you've looked at cryptocurrencies, you see them coming down in price. I'm looking, in fact, right now at the total market cap of cryptocurrencies, and they're about $254 billion. That's really quite down substantially over the last few weeks, and we've pulled back sharply. And this is actually a great time for the pullback for us here at Follow the Money, because we just released our 2020 portfolio update. We own right now about 13 different cryptocurrencies. And in this new 2020 crypto report we just issued to our Gold and Platinum members, we just told them exactly which cryptocurrencies of these 13 that we're adding more of right here, which ones we're holding through the current sell-off, and also which ones we are just selling and liquidating. And I think in the years ahead, this is a long-term game for us in cryptocurrencies. We're not here for the day. We're not day trading cryptocurrencies. We have taken stakes. We have been holding a stake in cryptocurrencies. We initially opened up our first position in Bitcoin back in 2013. We opened up our initial position in Ripple back in 2013. We opened up our initial position in Tron way back in 2017? Yeah. So, we have a long-term cryptocurrency investment strategy, and we're holding for the long term, expecting another big, massive rally. And it's all speculative. So the money just shows up when it does, and you never really know when the money is going to show up in this market and start driving it higher. But undoubtedly, we will see that again. And so anyway, for those of you who are Gold and Platinum members, you want to check that out. Just go to followthemoney.com and then click on the cryptocurrency portfolio in your member dashboard, and you can see that latest. There's two PDFs for you. You can check those out. It's a chart book of cryptos and also a report on which cryptos we're holding, which ones we're selling, which ones we're buying, and that's all happening right now in February. So we like to see these price pullbacks whenever we add. Obviously, that's a really good time to add to your positions. All right, so we've covered a whole lot today. We've talked about, this volatility that has struck in 2020. Where are we going to go from here? Are we going to see higher prices from here? Are we going to see lower prices from here? Well, no one has a crystal ball, but we've laid out why we're seeing the pullback. Coronavirus, the FUD around that, and also the FUD around Bernie Sanders here in the United States. We have, of course, a lot to monitor as we move forward. We want you to know that if you're not currently a member at Follow the Money, you're not currently one of our students, I encourage you to go to our website, followthemoney.com/join. Look at our different plans and pricing and see if there's something there that fits your personality, that fits what you're wanting to learn. And if so, come and join us. And at the very least, if you're not currently receiving our email updates, then simply go to followthemoney.com/email and sign up. We'll give you some free gifts there. We have a couple of videos. We'll send you a couple of PDF links. We'll send you as well. And just kind of get you started in learning more about the markets, trading, investing, and so much more. There's so much here that we teach. All right, friends, well, that brings us to the end of our broadcast. We're out of time, and as always, I want to leave you with a final word. And this time, it's a quote by Rudyard Kipling when he said, "Of all the liars in the world, sometimes the worst are our own fears." And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
All of the information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of ftmdaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.